What's going on, everybody? This is Steve with Mortgage Mondays. Just like most of you out there, I'm working from home today while these kiddos drive me happy. They drive me to happy thoughts. I was going to make this video today about the third step in buying a home. But with everything that's going on, I wanted to take a step to the side and let everyone know how today's events are affecting the market. To do that, let's take a step back. On March 9th, when the 10-year Treasury bond yield hit a record low rate of 0.32%. I'll explain what the 10-year Treasury bond is in another video, but when I tell people rates change on a daily, I really do mean it. By the end of March 9th, the rate went up 22 basis points. And then to add more fuel to the fire, it went up another 28 points on that close of the following Wednesday. What does that mean in English, Steve? Well, basically, rates went up 0.5 to 1% in a matter of days. I remember quoting someone at 3.5% the previous Friday. The next week, they wanted to go ahead and lock it in, and we were at 4.5%. Now, because of those 2 weeks of extremely low rates, it caused a refi boom. Everybody and their mama was trying to refinance. Now, with the significant increase of application, banks, not AFN, started to increase their rates to discourage people from applying. And this is what caused the rates to spark up so sharply. But why discourage people from applying? Isn't the goal of running a business to bring in more business? Let me explain. Since there's no prepayment penalties allowed, many took advantage of this and started to refinance. Now, this meant the majority of the loans from 2019 could be at risk of an early payoff before the system could even make adjustments from this to prevent this from happening. Now, earlier than expected payoffs are a problem because investors expect a certain amount of time, months or even years of interest to be paid on a loan in order to recover any cost of investment to generate a profit. Basically, the longer the borrower pays interest, the more money the investor makes. Short and simple. Recently, the Federal Reserve did another emergency cut and promised $700 billion to buy bonds and mortgage-backed securities, which should help begin to move things in the right direction. So what should we expect moving forward, Steve? Well, it's expected over the next 30 days, people are just going to start canceling their contracts and begin jumping ship. Now, but if you're currently under contract, do not be afraid. Continue to do business as usual. Banks are still funding loans, including AFN. Now, for those who were in the process of looking for homes and your pay was affected, don't worry, let's wait it out. This thing won't last too long. Now, for those who have a home and don't want to miss your mortgage payments, Fannie Mae did release a lender letter on March 18th addressing that, touching base on any forbearance plans for those being affected. So reach out to your mortgage servicer and they'll be able to help you apply. Today on March 23rd, Fannie Mae did release another lender letter allowing appraisers to do exterior-only inspections and provide more flexibility for them. Guys, we have been through much worse and survived. All right, when purchase applications data adjusting to population hit an all-time low in 2014, we still had over 5 million home sales. When rates were as high as 5%, we still didn't see a collapse in home sales. All right, so even at 4%, rates are still relatively low, and business is still moving. Today's rates are actually looking pretty good and should start gradually coming back down again. Not as steep like we just saw in the beginning of March, but they're going to gradually get there. So with that being said, for the next few weeks, let's wage war on this virus. Everyone, please do their part so that this thing doesn't stay any longer than what it should be. Okay? If you have any questions or concerns, please feel free to reach out to me. My name's Steven Rivera, and that's this week's Mortgage Monday.